Throughout history, private currencies dominated the economy as a medium of exchange. In the 1800s, much of the money circulating in the US was created by private entities, such as private banks, construction companies, stores, restaurants, churches, and even regular people. You can use these private banknotes to buy and sell things, assuming both the buyer and seller accepts the said currency. This happened because back then, government-issued currency had lots of weaknesses and faults, mainly liquidity problems, so private currencies were created to fill the void. In the 21st century, private money was barely used as today's sovereign currency, like the US dollar and the British pound, lacked the weaknesses of government-issued currencies in the 1800s. But that doesn't mean it is perfect. So in 2009, a white paper titled Bitcoin, a peer-to-peer electronic cash system, was published by Satoshi Nakamoto in order to solve this problem, which is the lack of trust in governments and the centralized banking system. The logic is that by designing a currency that relies on peer-to-peer software and cryptography, it can function as a medium of exchange without the oversight of banks and governments, solving the problem of trust, which is one reason why the paper was published in 2009, when people's trust in banks and the government were at an all-time low. Over time, the visions of Nakamoto brought many more innovations like Ethereum and the decentralized finance space, all with the same goal of eliminating intermediaries. The lack of trust in our financial system is a huge problem, as the whole banking system and economic activity is based on trust. If people do not trust the government, it can function effectively. If people do not think that the US dollar has value, then it is entirely worthless. So it is time to learn how cryptocurrencies have tried to solve the problem of trust, and why it failed at doing so. Cryptocurrencies are decentralized private digital currencies that rely on cryptography to safeguard transactions and issue new money. While the underlying technology is pretty much new, the concept of private currencies can be traced back from centuries ago. And to better understand the crypto phenomenon today, we need to look back at the 1800s. In the US, the government isn't the only entity allowed to issue money. Private citizens and businesses can too, and the usage of private currencies peaked in the 1800s in a period known as the free banking era. Now, these currencies first existed to fill the void left by government-issued currencies. And make no mistake, there were lots of problems with government currencies back then. The two main problems were the lack of small denominations and the lack of cash flow in remote areas. The lowest denomination of banknotes of government-issued currencies was $1, and $1 was a lot of money back then. A newspaper cost around a penny and a pound of beef cost around 6 to 8 cents. Obviously, it would be impossible for you to buy a newspaper that costs a penny with a $1 bill. So, there were some serious liquidity problems back then, which was why private banks stepped in to solve this problem. And sure, there were government-issued metal coins with small denominations, but there just weren't enough of these coins to go around. Now, that doesn't mean private currencies don't have major weaknesses themselves. Because private currencies were not backed by the government, if the issuer of the currency, for example a private bank, stopped operating, either because of bankruptcy or that they just left town, then the currency would become entirely worthless. The deregulated environment of private money means that people need to be extremely careful in which currencies to choose. And when they do choose one, they can only pray hard that the bank didn't fail and the bank didn't try to scam them. Of course, bank failures and outright scams happen a lot in this era. These banks earned the nickname Wildcat Banks for a reputation of unreliability, often located in remote areas that have more wildcats than people living in it, in order to impede people from reaching the bank to redeem their notes. And to make things even worse, these currencies constantly fluctuated in value, both in relation to the price of goods and services and to each other. So, how much money you had in your pocket was determined by whose notes you carried and when. It is not uncommon for people who enter a store wanting to buy some food had to pay more than they expected because the money in their pocket has just tanked in value. Now, I took my time to explain a little bit of history to illustrate that the crypto phenomenon we see today has happened before, and we can still draw some lessons from it even as today's situation is very different than in the 1800s. All of these forms of private money emerged to meet real needs that were not being met by government-issued money. And arguably, cryptocurrencies are also trying to solve a problem which is trust, primarily driven by the global financial crisis and the failure of trusted institutions such as banks and other financial institutions. Moreover, abuses of information and privacy issues quickly led to a distrust in government authorities, making more and more people think of third parties as more of a hindrance than a help. While I do not share some of the belief that I've just mentioned, I do think that this is still a real problem that needs a solution. And Satoshi Nakamoto thinks so too, since he published his white paper that tries to solve this issue with blockchain. Unfortunately, I get the impression that most Bitcoin owners and crypto in general do not care about this at all and only own crypto because of the fear of missing out while trying to get rich quickly. This is a shame, because I personally think that blockchain is really innovative. The use of a public digital ledger, visible by anyone with an internet connection, allows for extreme transparency that makes it secure and tamper-proof. And by bypassing banks, it allows for easier access of digital payments and basic banking products that could be beneficial, especially for developing countries with large unbanked population. But of course, cryptocurrencies have several fundamental weaknesses that, if not addressed, makes it impossible to become a medium of exchange for financial transactions. The first one is that cryptocurrencies are expensive and slow to transact with. It takes about 10 minutes to validate a Bitcoin transaction, and its network cannot process large transaction volumes. According to Binance, the Bitcoin network can only process 5 transactions per second, much fewer than Visa's 1,700 per second. This is because the records, also known as blocks, are limited in size and frequency. There are various proposals using a process known as forks in order to increase the transaction process per second. So, we may see a viable solution in the near future. A bigger problem that will hinder most people from using crypto as a payment system is wild price fluctuations, making it unreliable for day-to-day transactions. If you notice, this feature is similar to the wildcat banking era, when prices of private banknotes constantly fluctuated in value. This is of course not a sustainable future for crypto. Nothing whose value is so unstable can function for long as money. There are innovations like stable coins that try to solve this issue, but as of the date I'm writing this script, it doesn't look like a good solution. Tether, an offhand collateralized stablecoin, needs a central issuer in order to work and stabilize its value, which is exactly what the crypto enthusiasts want to avoid in the first place. They don't like centralized institutions. Meanwhile, Terra, a purely algorithmic stablecoin, is deeply flawed in its design and proved itself to be a stablecoin that is unstable. The crypto world is still a wild west right now. There are over 8,000 different cryptocurrencies today, most of them unreputable and have no clear purpose other than as memes, as vehicles for pump and dump schemes, or both. This is not so different from the 1800s, when the deregulated aspect of private currencies meant that scams were common. Crypto is also mainly used for speculation. The value on these cryptocurrencies relies on the drastic price increase and the media attention that comes with it, exhibiting the feature of a bubble. Although this is likely to decline for Bitcoin and to some extent Ethereum as it gains greater mainstream adoption, I'm not so sure about the rest. In the future, it is unlikely that crypto will be able to function as a medium of exchange as long as people still view it as an investment vehicle. And even if it does, it will have major impacts on monetary policy and other economic and legal aspects that might lead to more regulation for crypto. So, as of right now, cryptocurrencies are unable to function as a means of exchange, nor can they solve the trust problem that plagues our financial system.